Well, hello, everybody. My name is Lee Schwartz, and I'd like to welcome you to our webinar. Legislation is here, what you need to know now and in 2022. We are very happy that you've chosen to join us today. So if you have a question during the webinar, please open the chat box in Zoom and submit your question to all panelists. We are going to try to leave some time at the end for Q&A, but we're going to save those questions for the end. After the webinar, you'll receive a link to a survey along with a link to a recorded version. So many of you are already clients of SVA, and we'd encourage you to reach out to your SVA contact if you have questions coming out of this. If you're not a client and have questions, please reach out to me and I'll get you connected to a subject matter expert who can help. So there are still a lot of unknowns with legislation that's out there, but we feel it's important to understand what's being discussed, how it's different than what's in place now, and how it might affect you. So we've got two of our top tax experts ready to go. So let me introduce you to Dan and Eric. Dan Glomsky is a CPA, is accredited in business valuation, and is a certified valuation analyst, has his master's in taxation, and is a principal in our firm. Eric Trost is a CPA, has his master's in taxation, and is also a principal with SVA. Both Dan and Eric spend a lot of time helping individuals and owners of closely held and family-owned businesses minimize their taxes. So I'm very excited to hear what they have to say today. So without further ado, let me kick it off to Eric.
All right, thanks, Lee. Before we get started, a note on the title of our seminar, Legislation is Here. It's not quite here. It's almost here. So what we're going to start with is the legislation that's almost here, but maybe not as close as we thought. And I'll call the Build Back Better Act. Dan's going to talk a little bit about the Infrastructure and Investment Act that was passed, and some things with the employee retention credit that we want to make sure that information is out there, because that's current law and there are companies taking advantage of that employee retention credit. You don't want to be one that misses it. So we'll start with the Build Back Better Act. Oh, that went slower than I thought it was going to go. What I want to start with is a recap of how we got here, and with that history, a reference point. And the reference point I'm going to use goes back to 2008. And for those of us that remember what happened in 2008, there was a real estate crash. You might call it a debt bubble or whatever term it was for it. But there was a significant recession back then. And there was an argument about just how big the economic stimulus had to be that the government was going to pass. And they were talked about some big numbers. And at that time, $700 billion was a big number. And so after much debate, they finally passed this law in 2008. But I use that as a reference point because at that time, 700 billion was a big number. And now we're going to talk about even bigger numbers. So this is just to try to give you some perspective on it. As you start talking hundreds of billions and trillions, and wonder at some point, are our kids going to be talking quadrillions? It's hard to encompass those numbers without having some kind of reference point to them. So that's what we're going to use. We'll start with what happened in March of 2020. That's when the world kind of went upside down. In January, everything seemed normal, and there was maybe one reported coronavirus case in the US. By March, there was much more, and much more that probably were unreported. And at that time, the government recognized, okay, we've got a problem here. And they started with something called the Families First Coronavirus Response Act, which put 200 billion of government money into the economy, or what the spend was going to be. And what was in that was really the paid leave credits for employees that had gotten sick or had to take care of someone that had the coronavirus. So that was 200 billion to essentially say, hey, the government's going to pick up the tab for folks that have to be home because of the coronavirus, or to take care of someone with the coronavirus. Then later on, in that same month, CARES was passed. That's the Coronavirus Aid, Relief, and Economic Stability Act. That act is where some of the big stimulus came from. There was the $1,200 stimulus checks, there was the PPP, and there was the first phase of the employee retention credit. After that, there was more money added to the Paycheck Protection Program as all those funds were used up, and so more was put into it. And then in December of 2020, the Consolidated Appropriations Act was signed. That put another $920 billion into the economy. Most of that being in the form of a $600 stimulus per person, and then the Paycheck Protection Program round 2 loans. Also added some more to the ERC. Then in March of 2021, this was when Biden had his first piece of major legislation signed. That was the American Rescue Plan. That was an additional $1,400. And that stimulus came out then and also added some more employee retention credits. And then there was a lot of nothing. There was a Build Back Better plan that was tied to an Infrastructure Investment Act. And both of those were being marched through and debated in the House and in the Senate. And both of them had significant price tags. At the end of the day, the Democrats thought strategically they'd be better off passing at least one of those bills. And so they passed the infrastructure bill in November. And Dan's going to talk a little bit about that. That's 1.2 trillion of spending, mostly not paid for by tax increases. So the tax increases you might have been hearing about really are attached to Build Back Better. They're not part of the Infrastructure Investment Act. That really is just new spending. So to date, there has been passed 6.9 trillion of government aid since 2020, mostly related to coronavirus. That's about 10 times more than what the original TARP Act was back in 2008. So to add to that, there's the Build Back Better Act. That has passed the House, and that's the version we're going to talk about today. And the cost or price tag on that is about 1.7 trillion under how they currently, they call it score it. However, that price tag might be 3 or 4 trillion, depending on how realistic some of the other folks in government would score it. And it just depends on if programs are extended or not. That really is part of the problem with the bill that some senators, and mostly represented, I'd say, by Joe Manchin, are having the most trouble with. But let's go over what's in Build Back Better, because there's been so much news on it. And we want to see what's out there, what's been proposed, what's been cut, so people understand where this is heading. So what we have set up here.
Eric, just to quickly say,
yeah,
we get a lot of questions from clients currently as far as, okay, so I need to move now because the capital gains rates are going up and stuff like that. So I think really what we're trying to lay out here is some of the things that we may have heard versus where things currently stand. So I think that's really the focus of what we're trying to hit with these next couple slides.
Yeah, thanks, Dan. There's been a lot of news articles about what could be out there, and a lot of things, nowadays information exchanges happen very quickly. So when you have a version of something come out, it goes all over the internet and gets into the chat rooms, and it may change 3 or 4 times before the final, actually gets out there. But if you do, say, a Google search right now, you're going to find all sorts of things out there because it's all out there, and nobody updates their web pages when these things get updated. We'll start with, at the top, Section 1031, which is a benefit for real estate investors. It allows real estate investors essentially to trade their gains on one property and roll it into another property without paying tax. I don't know that that lasted very long in the original proposal, which was going to be a repeal. That was quickly killed. And so now the House version, which is our column on the far right, allows Section 1031 exchanges, just like under current law. The total cost, the original proposal was going to be 3.5 trillion. It's been trimmed back to 1.7 trillion. And again, that's under how they currently have it marked up. It could actually be more. But what has effectively happened is the House has trimmed back their own bill significantly. This is important because the House is probably where the tax increases were going to come from, and the ultimate spending was going to be set, and the Senate's a curb on that. So I would say anything that was taken out of the House bill, and we'll get to what some more of those things are, is probably not going to be reintroduced. The top effective rate for business owners under current law is 29.6%. Under the House version now as proposed, it would go up 3.8%. The original proposal, though, was going to have that go up to 43.4%. So it's been a fairly big scale back on the top rate for business owners. Another big one is the estate tax floor, which right now is 10 million, and it's adjusted for inflation, so it's really about 11.5 million. There was going to be a proposal to cut that back to either 5 million or 7.5 million. That sent a lot of people to their estate tax planners because now they feel they might be caught under an estate tax. Under the House version, though, that's been eliminated and the floor is right back to 10 million where it stands today. So there's been no change to that estate tax floor under this proposed legislation. The proposed legislation or the original proposal under Biden on the Build Back Better Act had a raising of the top tax rate to 39.6%. That's really going back to where it was before the Trump tax cuts in 2018, back up to 39.6%. That was cut out in the House version. So now it's 37%. That's where we are today. There was a lot of talk of moving the capital gains rate up or eliminating it. So the capital gains rate was just going to be gone, and whatever your capital gains were taxed at, is going to be your ordinary income rate. And so currently it's 20%. It's going to go up to 39.6%. And in the House version now it's back down to 20%. This had a lot of businesses at the end of 2020 concerned as they were selling to try to get the sale into 2020 or early in 2021. And there was a lot of concern that if you missed out on that opportunity, you were going to get a higher tax rate because it seemed like capital gains rates was going to be one of the things that was targeted and go up. And that didn't happen. The other thing that didn't change, which is surprising in the House bill, is the corporate tax rate. The top corporate tax rate now is 21%. That was cut from 35% back in the Trump tax cuts down to 21%. So it was a significant cut. And the Democrats were going to claw some of that back by raising it to either 28% or maybe 25%. The House version froze that rate at 21%. So there's really no raise in corporate taxes for most corporations. There is a tax cut within this proposed tax law, and that has to do with the SALT cap. For those of you aware of the SALT cap, SALT stands for state and local taxes. There was a deduction allowed for state and local taxes for any amount prior to the Trump tax cuts. The Trump tax cuts actually took that deduction away and said you can deduct any amount up to $10,000, which is not a very large amount for state and local taxes. And so that cut, tax cut actually, is the House wanted to pass and say, hey, let's raise that cap to $80,000. That really is effectively a tax cut. And it's a tax cut, especially for upper income earners that pay a lot of state taxes. And think of New York and California as folks that would have enjoyed that tax cut. In the original proposal by Biden, he was talking about eliminating the qualified business income deduction for those that make over 400 or 500,000. That elimination would have effectively raised business income taxes from 30% to 37%. So it was a 7% tax increase. The House version doesn't have that increase in it. So we're right back to current law for qualified business income. There is a tax increase on the net investment income tax that does apply to business income. So this is one of the tax increases that I think most affects what I would say our client base or small businesses, small to mid-sized businesses. That 3.8 net investment income tax originally was proposed that if you were over 400,000, you'd be subject to it. Now it's business income over 500,000. It currently doesn't exist on active business. So that would be a tax increase.
So Eric, there's a question in the chat about what you mean by active business, right? Or active income. So maybe you could expand upon that and just kind of give me a little more background on what QBI is, just to maybe share a little more information on those two things.
Yeah, and so the QBI, net investment income tax, I want to start with net investment income tax because I think that's what they might be referring to in the chat room here, is that active business income would be income that you participate in earning. So for example, if you own your own S corporation and that S corporation makes $500,000 before paying you a salary and you take out a salary of 100,000, the remainder of that 400,000 is taxed as income on your tax return. It does get a QBI deduction, qualified business income deduction, and it's not currently subject to the net investment income tax. Well, under the proposal by the House, to the extent you have income over 500,000 that's coming through from that S corporation, that income would be subject to the net investment income tax. When it comes to rental income, as long as it's passive, is subject to that net investment income tax already. But this would apply to real estate professionals who have active rental income. That rental income would now be stuck with this net investment income tax as well. They're not currently, but they would be stuck with it as well.
Right. So we kind of say active is really a person that's participating in a business, aside from the real estate portion. The real estate's got a slightly different rule from what makes you active. It's really the number of hours and your other kind of activities. But active is really your involvement in a business. On their current law, if you're active, we're not subject to that 3.8 no matter what amount of income you make. But if you drop below that, or if you're a non-active individual, passive investor, the 3.8 would kick in at at a certain rate, 400,000 at the current time.
Yeah, so and that's really where the tax increase is here that does affect the business owners, is it's a 3.8% additional kicker tax on income over that 500,000 from your business. So I wanted to also put a slide out there for where all this money is going, because it's not just tax increases that are happening. If this bill gets passed, there's spending that goes along with it. And found a chart where all that spending is, and this chart has the bill spend at $2.14 trillion as opposed to 1.7. But here's the approximate spending on where this is all going to go. So recap, well, where is all the money going to come from if they took away all these tax increases they talked about? They do have some tax increases in the Build Back Better Act, but they are much slimmer than what was originally proposed. There's a 5% tax on income over 10 million. So for those of you making over $10 million, there's an additional 5% tax that's on income that you make over $10 million. In addition to that, if you make over $25 million, there's an additional 3% tax on that. So really where this income tax hits is those making over 10 million and an additional kicker over 25 million. While that sounds very good in a just principle, it doesn't raise a lot of money because there's not a lot of us that are making that kind of money. I'm not in that boat.
I was going to say, Eric, are you categorizing yourself above that 25 million or?
No, I'm not. The other tax increase is that 3.8% net investment income tax we were talking about. So if business income is over 500,000, that income tax hits. So this really is a income tax that will affect a lot of small businesses. They have a good year, they're over 500,000. They are going to feel this 3.8% net investment income tax. And again, this is proposed. This isn't passed, so this is something that could happen. Another tax increase has to do with Section 1202 stock. We don't see a lot of this, but this is a kind of stock that's C corporation stock that if you sell it, you can you don't have to pay tax, or you don't have to pay a lot of tax on the gain. Well, there's a partial repeal of what that tax would be. And then there is some things in here with IRAs and Roth IRAs where you can't do conversions if you make too much money. And if you have IRA or Roth IRA accounts of $10 million, you can't add to them anymore. So there's been some, I'd say, negative press on how some folks have stocked up on their IRAs and Roth IRAs and are still adding to them. And this law would prevent you from adding any more to it.
Yeah, I think as we get into year end, a lot of clients were having, the question as far as, oh, I'm going to lose my ability to convert to a Roth from my IRAs and that type of thing. And at this point, that's not a change that we're seeing is going to happen. But again, we talk about what's out there and what's reality. And at this point, we don't know what reality ultimately becomes, but we're not seeing any traction with respect to limiting those Roth conversions for most people.
Right. Continuing on the tax increases, there's a couple of corporate tax increases. Again, they did not increase the rate, but they do have a corporate minimum tax proposed if book income is over $1 billion. So that's a very small percentage of corporations that would actually be subject to that, as well as tax on corporate redemptions of stock. And if a corporation has multinational operations where they have foreign subsidiaries. So it's a very slim number of companies, and it would be very large companies that would be subject to these corporate income tax increases. Trusts do get hit pretty hard, though, with these increases. If there is a trust that has a lot of income, and I'll say a lot of income, these aren't that high of numbers. If you have a business within a trust, this 5% tax, which kicks in for individuals at 10 million, it kicks in for trusts at 200,000 of income for the trust. And that additional 3% that kicks in for individuals over 25 million of income, it kicks in at 500,000 for the trust. So if this would pass, there might be a suggestion on rearranging the structure of your business if it's owned by trusts that are taxed unto themselves as their own entities. These trusts are going to pay much higher taxes than if it was simply owned by individuals, or at least taxed to the individuals.
Yeah, Eric, and I would also add to that, if you're creating a new trust, you might want to make sure you're creating the ability to kind of split the trust out maybe a little sooner to the beneficiaries and that type of thing, to have maybe that more income spread over more potential trusts, that type of stuff. Again, it's all prospectively trying to figure out what's going to happen. But I think the reality of it is, as soon as we start seeing these types of income limits and we think they're relatively small, I think there's definitely has to be some strategies we're going to be deploying here to kind of minimize that tax impact.
Yeah, and there's ways to set trusts up so that the trust itself can hold the assets, but the income is taxed to individuals, either the beneficiary or the grantor who set the trust up. And that might be what you're going to see a lot more of, is a type of trust that can still hold assets and hold those assets subject to a set of rules, but the income tax on those assets is paid by someone other than the trust. And then the other tax increase is that 3.8% net investment income tax on business income. There are a couple tax decreases within this Build Back Better Act. I'm not sure these tax decreases actually can last as they fight about the cost of this bill. One of those decreases is that SALT limitation we talked about, where the state and local tax limit, which is currently 10,000, would be raised to 80,000. The reality is that SALT limit moving from 10,000 to 80,000 really is going to help people that are more upper income and live in high tax states. That's not necessarily the target of what Build Back Better was supposed to help. And so I think it is likely that, an eventual version of this bill, if it does pass, is probably not going to include the SALT limit increase, or if it does, it's going to be limited to folks making under X dollars, and it might be $400,000. Another tax cut in this, which I think if it doesn't survive in this bill, is actually still going to get passed as a standalone, is that R&D expenses, which have been deductible forever, were scheduled to not be deductible starting in 2022, but instead would have to be capitalized and spread that deduction over 5 years. So that 5-year spread, instead of a current deduction, could be a significant hardship for what I'd call startup businesses, or businesses that pour a lot of their money into R&D, because now they don't get a current expense for it. They get a 5-year spread on that expense. There is bipartisan support for another bill that's outstanding that likely would pass that anyway if it does not get passed in Build Back Better. The other tax cut in Build Back Better is the child credit going from 2,000 to 3,000 or 3,600, depending on the age of the child, for one more year. That's a fairly expensive provision. And a one-year extension has a significant different cost than if this keeps getting extended over time. This is really what I think some of the senators have a problem with, is that including a cost of this bill at 1.7 trillion and having this as a one-year extension, when the thought is it would be continually extended, because once these programs start, it's hard to stop them. That really raises the cost of this bill to 3 trillion or 4 trillion, which is untenable for some. And so I think this is going to be one of the areas that probably will be cut before that final bill comes to pass, if it comes to pass. So I want to recap what's not in here anymore. And what's not in here is fairly significant compared to what we were hearing originally when this bill was going to pass. First thing is that individual income tax rates really don't go up unless you make over $10 million. So there was a lot of talk about where they were going to go to, or at least 39.6. That's not happening. Second is the capital gains rate. There's a lot of scrambling to finish selling businesses in 2020 and again try to sell them early in 2021. There's no proposed increase to the capital gains rate now. Next is the estate tax. Again, it was thought it was going to be a slam dunk that estate tax floor of 10 million was going to go down to something much less than that, either 5 or 7.5, which is what it was before the Trump tax cuts. That didn't go down either, nor did the other proposals out there to say you're going to lose your step up. That step up is still out there. So part of the original Build Back Better Act was there's not going to be a step up on assets anymore, which means that when someone passes away and puts those assets down to the beneficiaries used to take those assets, and their new basis was whatever the market value was when someone passed away. And so that was a great benefit as a beneficiary to receive things and essentially receive them tax-free, because you could receive an asset and then sell it and there'd be no tax on it. Well, the original Build Back Better Act was going to not allow that step up anymore. That's still there. There's also going to be a capital gains tax on those who died to make them pay tax on all those gains that weren't taxed yet. That's gone as well. There's no corporate tax increase. There's no wealth tax. There was an idea floated out there of a wealth tax that was, hey, if you're over, say, 1 billion of value or 500 million of value, we're just going to tax you based on your wealth. That's in addition to the income tax. We're going to make a tax assessment just based on what you're worth. And that died as well. So before we get to Dan here, I turn it over. Just want to talk quick about what is the likelihood this is going to pass. And I would say back in summer, it seemed like a very high likelihood with a lot of tax increases on it. Then it was really carved down in the House version, so not a lot of tax increases were there. And it seemed like this version had a good chance of passing until there was more debate about it. And the latest now is, I don't think it's going to pass in its current form, because there's just too much cost to it as they, keep finding out more about what this is going to cost if some of these programs are extended. And I think how the news has been coming out is that, if you heard the name Joe Manchin, he's the senator from West Virginia. That is essentially, we'll call him the 50th Democrat senator. And they need all 50 to vote for it. And Joe Manchin has basically been saying he's not going to vote for something this expensive. He very well may be running cover for some others that don't want it passed as well. But right now the focus is all on Joe. And the latest came yesterday of, it just doesn't look good that it's going to pass by this time frame by December, which is what the Democrats originally wanted. And so it's likely going to drag into next year. And I think it's going to take at least a couple months into next year of negotiations if it does pass, and it will be slimmed down from where it is right now. So what does that mean? We're going to have another seminar on this, and so we'll be sending out some more information on it. All right, I'll turn it over to Dan to talk about the Infrastructure Investment and Jobs Act and employee retention credits.
All right. Thanks, Eric. And I mean, I was a lot like Eric. I believe that, you know, and I was reading the information and really starting to change the you know, what the planning was going to be for my clients, right? Am I going to get that SALT limitation? I want to, you know, get the benefit there and started looking at things. Well, that all changed yesterday. So it's one of those things where, you know, we kind of advise our clients to, you know, be prepared. But you know, we don't have a crystal ball, unfortunately, and some of that translates into us not being able to, you know, we got to delay things. So we'll see how this thing plays out. But one thing that has passed is the Infrastructure and Investment Act. It's really not a tax bill, but there are some tax things in it. So I'll just, you know, kind of quickly hit them, but it's really of no consequence for most people. The most significant one, though, was the ending of the employee retention credit. And we'll go into the employee retention credit in a few minutes, but the third quarter would be the last quarter that employers are able to apply for the employee retention credit and receive those benefits. So it ended that program. There was also a big focus on crypto asset reporting, you know, forcing, you know, brokers to more so disclose to the government any transfer of digital assets in accounts. It doesn't come effective until January 1st of 2023. So there's the Wild West continues in that area for a little bit longer, but there is a reporting requirement that'll come with that. And then some real minor tax provisions about some automatic extensions in the disaster area. There's also the Superfund excise tax, which may impact clients or businesses that have hazardous substance and more so chemical manufacturers and importers of chemical goods that may see that rekindled or reinstated. So then from there, we'll go to the employee retention credit. And the, you know, this slide is, you know, kind of intended to just throw it all out there. I know the people that tell me presentations shouldn't have much as far as words on the slide, but we like to put it on there because it makes me feel good. But the reality of it is we have the employee retention credit, which when we start calculating these for a lot of clients, they're really almost equivalent to, in some cases, better than even the PPP loans that clients were getting. So for that reason, we really wanted to just kind of reintroduce this to everybody again and make sure that we're communicating that if you haven't taken this opportunity to claim the credit, that you go out and you see whether you qualify and then work on optimizing that. So then we'll go through the slides, we'll go through the information as far as what qualifies. And the reality of it is for 2020, you had to have a reduction of 50% or greater of, or greater than 50% of a reduction in gross receipts compared to 2019, or a partial or full shutdown. And it's really a government shutdown, meaning that the government instituted some kind of mandate or requirement that you weren't able to do certain things. And as a result of it, it forced you to shut your business down. So, you know, we really kind of look at the first criteria of evaluating whether a client qualifies is, you know, whether they have a reduction in revenue. And then, you know, if they don't have a reduction in revenue, we really go back and see it, well, we're partially shut down in some respects. And we want to look at the facts and circumstances around those particular events.
Hey, Dan.
For that, so yes.
Yeah, just to be clear, that 50% reduction in sales is measured on a quarter by quarter basis, a quarter in 2020 to the same quarter in 2019.
Yeah, a great point, Eric. And a lot of things we do reanalyze so what happens is you evaluate a quarter, and if you let's say we look at first quarter of 2021, and as we can see here, we have a 20% reduction need, or more than 20% reduction for 2021. So we look at the first quarter of 2021 and we compare it to your first quarter of 2019. And if we have that 20% or greater than 20% reduction, we can qualify for that first quarter, and then we automatically qualify for the second quarter. And then we would look at the second quarter and find out if we qualified again, we still have that 20% reduction in the second quarter. We then qualify for the third. So we'll go through an example in a few seconds as far as how that works, but it's really a quarter by quarter analysis, as Eric mentioned. The other criteria we want to look at is eligible wages. So the employee retention credit is 70% of the employee's wages up to $10,000 per quarter for the 2021. And for 2020, it's 50% of the wages in total up to 10,000 for the year. So there's two different standards as far as what the calculation is for various years. But we look at qualifying wages, and we're able to take, if we have less than 100 employees in 2020, we can look at everybody's wages. For 2021, if we have less than 500 employees, we can look at everybody's wages, and they're all part of the calculation. If you have in 2021 more than 500 employees, then you only get to include the wages that you paid for somebody to be, basically, you're paying them not to work. So that's just some minor details with respect to that. So let's go through some, so we have the 50% for 2020, and then we continue to get the qualifications until we reach at least 80%. So let's look at the example for what 2020 might look like, just to give you a quick flavor of it. So we have for 2020, we have receipts, let's say of 100,000 compared to 210,000 in the prior year. It's a reduction and of 110,000, so 52%. So we qualify. So that makes us eligible for the first quarter and the second quarter, and therefore we can look at the wages. But again, when we combine the wages during those quarters, we can only take up to $10,000 of wages for the employees, all assuming we have under 100 employees. If we look at the second example, if we qualify for we have a Q1, we have a 20% reduction, or a 52% reduction, and then a 22% reduction. Again, we're not going to be able to, we'll be able to qualify for that because we have to get above that 80% mark, and we haven't done that yet. So then we get it for the quarter one and quarter two, and then quarter three. So we end up getting all three quarters for 2020. And again, when we look at everybody's wages for 2020, we get a max of $10,000 of wages times 50%, so 5,000 per employee for the whole year. But we look at it by quarter. So then let's look at 2021, because it's still a little bit difference to it. Here we're looking for a greater than 20% reduction. And again, we're looking at that 80% threshold as far as recovering. And these examples, again, they don't change the fact pattern other than we're eligible for, the first quarter makes us eligible in the second quarter. For 2021, though, the credit is 70% of the qualifying wages, or $7,000 per employee per quarter. So it's a substantial amount of money in 2021 compared to 2020. And then the second example here just basically says we're qualifying for all three quarters because we qualify for the first quarter and the second quarter. And then although we didn't qualify for the third quarter, it gets dragged along because of our qualification for Q2.
Okay, so I just want to interject right here. If there's a lot there as far as the qualification process goes, but what you want to be capable of doing is saying, here's what my quarterly sales were from 2019 through 2021 third quarter. So if you can break all those sales out quarterly, and if you haven't taken this credit yet or talked to your CPA about it, you want to take a look at this information, talk to your CPA about it and say, do I qualify for these employee retention credits? Get some help on this analysis, because if you do, the credits we're seeing are fairly significant, tens of thousands of dollars and even more. And so you don't want to miss out on that. There hasn't been as much, I would say, publication of just how big these credits can be and how important it is to look at this. So if you take away one thing out of here, please take that away, because if you're not taking advantage of it, and you could, you're missing out on quite a bit of a credit here.
Yeah, if you, like I said, if you haven't, evaluated or taken it. It's really a step that you owe yourself to do. The other thing we want to be careful on the ERC is that the PPP loan wages, so whatever you use as far as PPP loan forgiveness as wages within that application, if you use those wages for the PPP application and they were needed to get you to the number that you need to get full forgiveness, the wages that were used for that full forgiveness amount cannot be used for the ERC. So we can't double dip on what we use for wages. But again, we analyze it a little bit further, and where we kind of take advantage of this situation is we look at that PPP application and try to drag in as many other expenses into that process so that we don't just get the application forgiveness on just wages, right? We have these other expenses, which frees up more wage opportunity for the ERC. So we have the ability to do a lot of optimization within the two, but what we don't want to do is submit that PPP application, then later on find out we want to go qualify for the ERC. We may have created some problems for ourselves. Just a quick flow chart as far as some things we consider, if we qualify for the ERC, right? And then we say, yes, we qualify. So we look at the 24-week period, and we want to make sure we get at least 60% of the wages for the PPP. But we also want to make sure that we optimize the expenses related to other things. If we don't qualify for the ERC, we're fine with the PPP, just grabbing, the wages and calling it a day. Again, we want to, set the process up where we're grabbing the PPP application, seeing if we qualify for the ERC or the ERC. And then from there, we want to make sure that we're optimizing both the employees that qualify and the amount needed for the PPP forgiveness. So we really want to we want to kind of manage the two. And again, make sure, like for the second draw, we got some additional expenses we can pull into it. We want to make sure we grab those or look to see if they exist. So again, we can just rely on as minimal amount of wages for the PPP forgiveness as possible and free up more ERC opportunity, assuming we qualify.
Just to say how prevalent this credit is, if you go back to some of these programs, the original PPP had very little qualification. And I'd say 4 of our 5 clients were taking it, probably even more than that. The second round of PPP was actually a little harder to get and was probably more like 1 of 5 clients. But this ERC, I think, has been at 1 of 3 or 1 or 4 clients are qualifying for it. So, it could be at least a third of clients that we have are qualifying for it. And if we haven't hit them all, we will be when we're going through this tax season. But if you haven't talked to your CPA about it, you want to, because it's a fairly common credit to be able to qualify for.
So I know I hammered a lot about, optimizing the PPP loan and the ERC, and the reality of it is, as far as your priorities, as far as what you want to get, the forgiveness on, certainly we want to get full forgiveness on the PPP loan. It's $1 for $1. There's no tax consequences to the PPP loan forgiveness. So if you get those dollars forgiven, they're tax free. The ERC is taxed, and so it results in a tax consequence. But again, you still come out far ahead by claiming it than not claiming it. So when you prioritize the two, the PPP always gets the first priority. So when we're optimizing, we're making sure that that PPP loan has full forgiveness, and then we start grabbing at the ERC dollars. So just a few parting comments. I meant to, the ERC credit is taxable income, so we want to be aware of that. It's taxable in the year that you're in essence claiming the credit. So whether you receive the funds or not, the credit is in all likelihood taxable in the year that you're making your application for that ERC credit. The ERC credit's claimed on an amended 941, so payroll tax return. And there's R&D credit wages and work opportunity credit wages that if you use those for the R&D or the work opportunity, you're not able to use them for the ERC. So you got to be careful that you're not double dipping again. But again, we're experiencing a lot of opportunities here. So we want to really kind of make sure clients give that some consideration.
Yeah, and the ERC is a better credit than R&D or the work opportunity credits. So you'd actually use the ERC credits first, and then the remaining wages that you could for the R&D or the work opportunity tax credit.
Good point, Eric. Good point. So then I just want to touch on a few other tax considerations that we've kind of been working through. The state of Wisconsin, for most of our attendees, there was a bracket reduction, which if you're a married couple and you're over 355,000, could produce about a $3,000 tax reduction. And then if you're a single individual over 266,000, it's about a $2,000 dollar savings from that perspective. So these are things that we want to think through from a planning perspective, because one of our opportunities is what is called the Wisconsin entity tax election. And what it has done is this reduction in rates have, kind of recalibrated when somebody's a good candidate for that Wisconsin entity level tax, or any, other states may have other adjustments and other opportunities to take that entity level tax if you're a business owner and a pass through income. The other thing we had published out there was a cost of living increase for 2022 is about a 5.1% we're seeing for the most part. So we're seeing your ability to defer more money into your 401k, maybe some deduction limitations are going to take a little bit or quite a bit of an adjustment upward than we normally have historically seen. So you want to be aware of those if you're one of those that caps out on your deferrals, and as we plan, what deduction limitations might affect us. So before we wrap it up, just a quick summary on things. This slide was kind of prepared before yesterday's comment. Be prepared to make some quick moves here at year end. I'm not sure I don't have any confidence at all that the Build Back Better bill is going to get into movement here. So I think from our tax planning perspective, we kind of revert back to what we were doing pre Build Back Better proposed legislation. I know where your 2021 income is at, because we did talk about the investment income tax, or the net investment income tax, that 3.8% that looks like it could be affecting businesses going forward. It might be that you want to recognize a little bit more income in 2021 versus 2022 if there's a trade-off between the 2 years. But kind of knowing where your income is at is probably important from that perspective. And then continue to follow us as what will the Senate do? And right now we know the Senate's not doing anything, but we would expect something again, probably kicking back in January. And Eric's right, it's probably going to take January, February, it could even take into March. So I think a lot of the things that we thought was going to affect 2021 are probably now off the table, and we're probably just looking at adjustments for 2022. I don't know, Eric, you got anything else to add?
No, I think that's right. It could even be delayed further. I look at it as, once they miss their deadline here for Christmas, which is really what they wanted to do at the end of the year, I feel like some of the time pressure is off them, and then it really is going to be, do they want to get something passed prior to elections next year that they can tout as an accomplishment? And so I think they're going to take their time then in getting to that point.
I think there's also a pressure, the inflation's huge, right? I mean, we're dealing with price increases everywhere. We're dealing with supply chain issues and so forth. One thing I think the Senate's getting some pressure on is the impact of the Build Back Better bill on inflation, right? By giving tax cuts and that type of thing, you feel more inflation, right? And does that pressure them to do things differently, or further reduce some of the benefits that bill is going to crank out?
Yeah, there is a school of thought that if you keep adding money into the economy, it does cause inflation.
All right. Well, Dan, Eric, so much information. I know you guys have a lot to keep up with and everything changing on a daily basis, but great overview of everything going on right now. I just want to encourage everybody, if you have questions, please send them in via the chat function now. We've had a handful of questions coming in, and maybe we'll work sort of our way backwards, if that sounds okay, guys. We've got a couple questions that came in on ERC. Most recent one was, how does it work if you have related businesses with similar owners?
Yeah, so the ERC requires you kind of have to, if you're a common ownership, I don't remember the percentages off the top of my head, but if you have common ownership, you got to aggregate all the activities. So you got to look at the revenue in total by quarter, regardless of which entity ordered it. So for example, I had, and even with the employee count, right? So I had one client that had 2 organizations and ended up with 102 employees, but had the revenue reduction. So I could only count, the employees that were paid not to work, but you have to aggregate all the entities that are in essence related.
Yeah, Dan, to be clear, that's the 2020 rule. The 2021 is 500 employees.
Correct. Yes. We were looking at a 2020 situation, but it was more of an example where, individually they would have been fined from under the 100 employee count, but because we aggregated them, all of a sudden they were over, and in essence made them, it really not a productive credit for them.
One of the questions that came through on ERC a little bit earlier was, for the ERC setup credit for a new business, does this end in Q3 as well?
No. So if you're a startup, and it had to be after, I think, February of 2020 or something like that, you have it's still eligible to look at it for, I believe, the 4th quarter. But the reality of it is, that's the only real example that allows for a continuation.
Yeah, so that, and you're comparing, as a startup, you're comparing this year's wages 2021 to 20, or sales to 2020, because you don't have any 2019 sales. So you're just looking back 1 year on that comparison.
All right, so let's go back to Eric, some of the topics you covered with the legislation. One of the questions we had come in during that time was talking about, and you're going to have to jog your memory on exactly what this is referring to, but does the 3.8% apply to S corps and partnerships, or just S corps? So I'm thinking it's S corps and partnerships, or just C corps.
Yeah, so the 3.8% doesn't apply to C corps at all. It applies to the flow-through income that comes through from flow-through entities, which is S corps and partnerships and things that are owned directly 100% by an owner, reported directly on their individual return. So all of those areas you could have business income in, it's really business income that's taxed on an individual return, which is those types of entities, but not C corps.
Okay, great. During that time also, there was a little bit of conversation around active income. Can you talk about what that means?
Yeah, I'll try to expand on that better. Active income is essentially business income that's being generated through your own efforts. You have to have a certain amount of time within that business to qualify for it as active income. But being active income in we'll call it the current law, which is not the House version, but the current law, that's a good thing, because then you don't pay that additional 3.8% tax on it. So you want active income for this purpose. If it's passive income, that's the opposite of active income. If it's passive income, that implies a business that you're not into, that you're not spending time in. That income right now does have the 3.8% net investment income tax already on it. So the proposal within the House passed legislation is that they're going to add this 3.8% investment income tax to active income, which it currently doesn't apply to. That's where the tax increase comes. So if you have active income right now, no 3.8% tax. If this House bill passes in its current form and you have active income, that income over 500,000 is going to be subject to this net investment income tax.
Okay, thanks. So I think the person asking this question was a or is a realtor property manager. So can you talk about sort of how this would apply to somebody in that situation?
Yeah, so for a realtor property manager, those types of activities, not rental real estate, but this is for someone who's making money realty, selling, say, commissions, or doing property management services. If that's producing flow through income, either because it's on their own return or it's through an S corporation, that's active income for them if they're working in that business, and they would not be subject to the 3.8% investment tax under the current law. It's only if this bill passes and their income gets over 500,000 that 3.8% net investment income tax would apply. So that would be a tax increase for that person that's working as a realtor and property manager. If this bill passes and they make more than 500,000, they're going to feel this tax increase.
Okay. One last call for questions. A lot of ground to cover today, guys. I know there's a lot of it's a busy time of year already for you, and having to dive into all this, and then here we go. One day it just all changes. So last question we'll take was, I think this is from the same person, realtor, property manager, and just asking about gross income or net income under 500,000.
Yeah, I should be clear on that. It's net income. So it's after deductions. So that's when it kicks in, is your net income has to be over that 500,000 for that 3.8% to kick in under the proposed law, not the gross income.
Okay, great. Well, we are getting towards the end of our time. As we wrap up, I just want to let everybody know that you can visit svaccountants.com, where the recording of this webinar will be located, as well as e-guides and articles on and upcoming events. Sign up for our tax alerts. Please do that as this information changes. We do a really good job of getting information out there. So that's one way to make sure you're getting good and fast information. And lastly, I just want to remind everybody on the webinar that the SVA team is only a phone call or an email away. So if you're a client, reach out to your SVA contact as questions arise. And if you're not currently an SVA client, contact me, Lee Schwartz, and I can get you connected to a subject matter expert who can help. So thanks again for joining us today. Have a great rest of your day. Happy holidays. And as of right now, we don't have a webinar coming up for a little while, so I'll just go ahead and say Happy New Year as well. Bye, everybody.